Hello and welcome to the Goldman Sachs Weekend Macro Call. I'm Mark Wilson. I'm going to be the host for this weekend's call, and I'm going to be joined by my colleague Leah Larson from our investment banking division. Given the prolific policymaking and executive orders coming out of Washington, there's been plenty to keep us on our toes in markets. We also have plenty of content to cover in the call on the back of that. We're going to start with Alec Phillips, our chief US political economist, to cover the latest on policy announcements as well as latest thoughts around upcoming tariff implementation. We're going to have Jan Hatzius, our chief global economist, on to discuss the latest on the US growth outlook, as some incoming data does show a weakening, and we'll also cover latest inflation readings and our expectations for the Fed from here. Ryan Hammond from Equity Portfolio Strategy will join to discuss the momentum unwind at play in US equities, as well as our latest work on positioning data. We're going to have Christian Muller-Glissman on, our head of asset allocation research, to discuss year-to-date performance and where investors should be focused from here. Nicholas Garnett will be joining to discuss the latest from our German economics team in the wake of the German election results last weekend. And we're going to finish with Carsten Wohan, our co-head of M&A in Europe, as we do see a distinct pickup ahead in European M&A. Before we get into the speakers, could I just remind listeners that this call is for clients of Goldman Sachs only. If anybody else is on the line now, especially members of the press, please could I ask you to leave. Great. So our first speaker is Alec Phillips. Alec is our chief US political economist. Alec, arguably, many of the policies are now coming with growth headwinds when we consider immigration and DOGE tariffs. And some of these are just being executed via executive order. I think Trump's signed more than 50 now since inauguration. This compares to some of the growth supportive policies such as tax cuts, which need to go through Congress and obviously take a little bit longer. And even then, net of that, I think we're talking about GDP neutral. And so inevitably, some of the growth concern is building in the market. The question is, when can we expect meaningful positive headlines on tax policy and some of the longer gestation policy that is going through Congress at the moment?
So, I would say first, we have assumed that the mix of policies over the next couple of years on average would be roughly neutral. But we have thought that the drag from our assumed tariffs, immigration changes, et cetera, would be, slightly negative in the near term, i.e. in 2025, and then turn a little bit more positive in 2026. And so from that perspective, this isn't really that different from what we were imagining. I will say, two general points. First, I wouldn't overestimate how positive of an effect the tax cuts will ultimately have, simply because most of what they are doing is extending what's already there and set to expire, and not, necessarily doing a big new tax cut. And then second, to your point, I think it's just going to take a while for all of that to get through. It probably doesn't get through until the second half, though it probably has sped up a little bit compared to what people might have thought several weeks ago. So on the first point, using round numbers, the existing tax cuts are worth roughly $400 billion a year, or around 1.33% of GDP. So there's a little bit more of a positive effect in the near term because there are some business provisions, investment incentives that would be reinstated. But overall, most of what we're talking about here is essentially just keeping what we have and not adding to it. We do assume that there will be a smaller amount of net new tax cut, and that's essentially things that President Trump had talked about during the campaign. So no tax on tips over time, state and local deduction, a 15% corporate rate for manufacturing income, and so on. The overall, if you took all of those things together, the total would probably be another 1% of GDP or something like that. So on the same general scale as the expiring tax cuts. The trick right now is that the plan that the House has put together envisions $450 billion over 10 years in total tax cut. So call that $450 billion a year. Of that, you would think, okay, $400 billion or something like that is extended tax cut. $50 billion as new tax cut. The numbers are a little bit more complicated than that. So I think it does actually still accommodate something similar to what we have been imagining. And so our assumption is they do around a little bit less than $100 billion a year of net tax cut. More on the individual side works out to around 0.3% of GDP. And then the only other thing I would say on all of those numbers is some of that will be offset with spending cuts. They are, debating something like $1.5 trillion over 10 years of spending cuts. The first few years, those spending cuts would probably be smaller than that. So, if it's $150 billion a year on average, it's probably not even $100 billion in the first few years. But over time, the tax cuts, the new tax cuts might be outweighed by the spending cuts. So, overall, it's a potential positive. But it's not that big of a positive. And the key point would be it's certainly not nearly as large as what we got in 2017 at the start of the last Trump administration. In terms of timing, the first thing they've got to get through before they can do anything more on the tax cut piece of it is March 14th, which is the potential government shutdown, and the risk is definitely higher than usual of that happening. Once they get through that, I think they will have a final sort of House-Senate deal on the framework, so just on the plan, probably by early April, and then that sets them up to pass the actual tax legislation itself, along with whatever spending cuts they can figure out. That probably doesn't happen until, best guess would be late July, early August, and it certainly could slip into September. So, we're definitely talking about the second half, optimistically about Q3, but if things don't work out according to schedule, you could get later into the year. And of course, ultimately, the deadline for all of this is December 31st, which is when the tax cuts expire.
Thanks, Alec. And then if we turn to tariffs, huge amount of focus now on the imminent Canada and Mexico tariffs due to take effect next week. Can you just run us through your impact that you expect from those specifically? And then as a second question, can you discuss what else you expect to come from Trump on the tariff front, which jurisdictions and when, and the sequencing of remaining tariff discussion?
Sure. So as you said, March 4th is the next tariff deadline. Technically, what President Trump has said about that is that the Canada and Mexico tariffs, so 25% on Mexico, 25% on Canada, except for the 10% on energy from Canada, that those would take effect March 4th. And then he also said it was not entirely clear, but implied that there would be another 10% tariff on imports from China taking effect that same day. I think the base case here is that we are not going to get tariffs on Canada or on Mexico announced on March 4th and actually implemented, I should say. There's clearly a chance that could happen. And at some point, Trump will need to, come through on some of these threatened tariffs, not necessarily on Canada and Mexico, but, somewhere along the line. But I think what we might end up seeing is just that additional 10% on China. We have assumed roughly another 10 percentage point tariff on China. So, whether that comes on March 4th or not is certainly uncertain at this point. But I think it is plausible that we could see basically what we saw the last time around, which is threatened tariffs on Canada and Mexico and China. China ultimately sees the tariffs, Canada and Mexico doesn't. And then the market comes out of that being relieved that we haven't gotten the Canada and Mexico tariffs, but we're left with another 10% on China. From there, March 12th, steel and aluminum imports are likely to take effect. Those were announced already. The only question will be whether there are exceptions to that. It's not that important economically, but it will be important as a signal just to see kind of what that looks like. And then the big one is April 2nd. Now, the original memo that Trump signed on trade policy on Inauguration Day had an April 1st deadline for all kinds of recommendations from the U.S. Trade Representative, Department of Commerce, et cetera. Those are all still, going to be coming out. And April 2nd, the day after the recommendations are due, is sort of the as soon as date for when some of these things could be implemented. And the administration, both Trump, Howard Lutnick at Commerce, and others have been pointing people to April 2nd as a date for action on some things. The types of things that might be announced would be auto tariffs, reciprocal tariffs, tariffs on critical imports, and other things. I would say, without going into all of the different possibilities, I would say in general, it seems likely that we will get announcements on some of these things, but not direct implementation. There are a number of things that just take longer. The reciprocal tariff, if they end up doing it, would be very complicated. Some of these critical import tariffs would probably require longer investigations under Section 232, the national security related process. That can take several months. So, I think we're likely to see some things announced April 2nd, but probably not direct implementation of most of that. And in terms of our expectations, our standing expectation at this point is that we have another 10% on China that could come on March 4th, that could come later. We think that we will see tariffs on roughly $600 billion of critical imports. So that's things like steel and aluminum, copper, which was just announced, potentially oil and gas, pharmaceuticals, semiconductors, et cetera. And then we are also expecting a tariff on auto imports from the EU. And I will point out that Trump did mention that during his cabinet meeting the other day. It's possible that we will see an initial announcement on a broader tariff related to the EU or a broader auto tariff. But our thinking on that is that the two places where those intersect pretty clearly is the EU. And so if either one of those is going to happen, the place where you would see it most clearly is on EU auto imports. For now, we think that the kind of across the board tariff is avoided. And I think the gray area right now is just what comes out of the reciprocal tariff idea. Clearly, he's very interested in it, but it's also clearly very, very complicated to implement. And it seems likely that what that could lead to is just a lot of bilateral negotiations on individual tariff rates.
Great, Alec. Thank you very much. I'm sure we're going to hear plenty more from you on these issues in coming weeks, but thank you.
Thanks.
Next, we have Jan Hatzius. Jan's our Chief Global Economist. Jan, thanks very much for joining. The noise, both in the market and from clients, and the questions around the possible US growth slowdown and the uncertainty around that, given tariffs, DOGE, and some other new policy implementation, has really picked up this week. What's your take on current trajectory of growth estimates, and can you remind us of your estimates and the risk to those?
Yeah, sure. So the data have clearly been, broadly weaker than expected in the last week or two, and we had retail sales numbers, real consumption numbers, which are based largely on the retail sales numbers coming out today, new home sales numbers. All of that has eroded, very mechanically, or GDP tracking for the first quarter from close to 3% a month ago to, somewhere well below 2%. Now, some of that is probably a timing issue. I think there's some evidence that the January consumption numbers were affected by residual seasonality and bad weather. And we do think that there will be a rebound in subsequent months, and maybe also a rebound in Q2 to offset some of the weakness in Q1. But, on net, it's been clearly weaker than expected. The sentiment indicators have also deteriorated, and I think that's most visible in the consumer sentiment and confidence numbers from the University of Michigan, and this week the Conference Board. And I think the best explanation is that we've seen an increase in inflation expectations on the back of not so much actual inflation numbers, but really the tariff threats and the worries that people have following a period of much higher inflation that will see another significant price increase. I think the key to watch to see how much weight to put on all of this is what happens in the labor market. That's the traditional, the kind of arbiter and amplification mechanism in the US economy. So far, I think the labor market numbers have been mostly reassuring. The employment data for January were generally reassuring. Despite a lower headline number, we had a decline in the unemployment rate, and we had some upward revisions. We are watching the initial jobless claims numbers. Last week, we did have an increase by 22,000 to 242,000. That's not related to DOGE. It's not related to the federal worker program. It's really driven by other things that are not as easily allocated to a particular policy change. There's also been an increase in the federal worker claims program, but that is only worth 1,000 or 2,000, so a much smaller number. But 1 week is not something that we generally put a ton of weight on as far as claims are concerned. If we were to see ongoing numbers in the 240,000 or more range, then we certainly would start to pay more attention. My takeaway would be that at this point, we're still expecting moderate growth, under our baseline assumptions, which Alec just talked about, that the Trump tariffs ultimately stay somewhat more limited than the threats, no Canada, Mexico tariffs, for example, and maybe an increase in the average US tariff rate of 4 or 5 percentage points. Our forecast over the next 4 quarters is only at around 2%. It's not too bad, but this is in line with consensus. But that's the first time in 2 years plus that we're not above consensus. So that is, I think, a noteworthy change. And clearly there are some downside risks that we're watching, especially in case the tariffs are more aggressive. And if that were to undermine sentiment and perhaps even hiring, then we would start to get more concerned. But at this point, moderate growth is still the baseline.
Thanks, Jan. And then if you marry that slightly weaker growth outlook with some of the incoming inflation data, we had the core PCE numbers late this week. Where do we stand on the inflation view now, and what does all that together mean for the Fed?
So the inflation numbers this week were in line with expectations. We were at 0.3%, 28 basis points on core PCE, and the year-on-year rate is 2.6%. That's below the 2.8% year-on-year rate that we've seen for most of the last 6 months or so. Our expectation is that we'll probably stay around the current rate, around 2.6, in the remainder of 2025, basically because of 2 opposing forces: underlying disinflation on the one hand versus the mechanical impact of tariffs on the other hand. On underlying inflation, I would note that the labor markets continue to rebalance, and we can certainly see that in terms of job openings and quits and assessments of labor market tightness. We can also see it in the deceleration in wage growth, which has continued. And then the other, factor bringing inflation down over time is that the catch-up inflation, the increases in prices in areas where prices are only adjusted occasionally, maybe once a year, that catch-up inflation has decelerated. And you can really see that in the January 2025 numbers compared with January effects in prior years. But then against that, if we do get a 4 to 5 percentage point increase in the average tariff rate, our rule of thumb is that each percentage point is worth 10 basis points on core PCE. So that gives you about half a percentage point of increase in the core PCE price level. And those 2 factors roughly cancel out, and you stay at around 2.5% or a little bit more on a year-on-year basis. I think in that sort of environment, with our baseline growth forecast and that type of inflation picture, the Fed can certainly still wait. There's no hurry for additional rate cuts. Our baseline forecast is still that we'll get a couple of cuts. We have one in June, we have one in December. I think it certainly could take longer if growth holds up reasonably well. I mean, the same argument that you might be making now, that there's no urgency, could still apply as we move into the spring and ultimately the summer. That's certainly possible. It could also be, earlier, maybe a little earlier, if growth were to continue to come in on the lower side. If growth worries really rose, and especially labor market worries really rose, the Fed could shift quite quickly from being on hold to cutting further, because they are starting from a 4.25% to 4.5% funds rate, and they probably wouldn't want to wait too long if we had a bigger threat to the resilience of the labor market. So, it's going to continue to be data dependent. Doesn't look like they're going to move anytime soon, but of course we are watching all these numbers very closely.
That's great. Jan, appreciate your thoughts as ever. Thank you. Next up, we've got Ryan Hammond from our US Equity Portfolio Strategy team. Ryan, in many ways, US index level equity performance has been quite resilient, but underneath the hood, momentum has really been waning and performance has been quite challenged for people. How much further do you think we have to go in this US equity momentum unwind?
Yeah, sure. At the index level, like you mentioned, the S&P 500 is down about 5% since the peak last week. That brings the S&P to flat on the year, but I'd note that the equal weight S&P 500 is still up 2% year to date. Based on what we see below the surface of the index level, we would argue that this unwind has been driven by a combination of both the market revising down its growth expectations and a positioning unwind. So, on the growth side, the equity market had sharply revised up its growth expectations post-election day. So our cyclicals versus defensives basket had rallied by about 10% through late January. But now some of the concerns about the growth data that have mounted in recent weeks that Jan mentioned has seen equity investors reprice those expectations lower. So our cyclicals versus defensives basket is now 9% off its highs from late January and is basically at pre-election day levels and the levels that we saw prior to the summer recession fears in 2024. On the positioning side, the unwind of the most popular trades has been severe, as you mentioned. Our momentum factor fell by 5% over the past week. That's a third percentile event during the past 10 years. And the momentum factor has looked a lot like cyclicals versus defensives recently, so heavily tilted towards financials, away from healthcare and staples. And the reversal has been especially painful in retail exposed pockets of the equity market. So a basket of retail favorite stocks has dropped by 17% since the market peak on February 19th. You see the same thing if you look at Bitcoin exposed stocks or non-profitable tech stocks. So, in terms of the near-term path forward, we really think that growth data are in the driver's seat for the equity market in terms of the next leg from here. Next Friday's payrolls print will be an important test for the equity market and could dictate whether or not equity investor growth expectations stabilize or deteriorate further. It's possible that a washout in positioning, which has historically been a tactical buy signal for equities almost outside of some of the macro data, serves as a bottom for the equity market. And here, I would really focus on our sentiment indicator. It's a positioning metric that combines institutional, hedge fund, mutual fund, but also foreign and retail investor positioning data. And when that has been extremely negative, i.e. more than 1.5 standard deviations in negative territory, that historically has been a tactical buy signal. The reading from last Friday was plus 0.7 standard deviations in stretch territory. And so we'll be watching this week's reading closely, but I think you'd have to see further positioning unwinds to get somewhere close to what we would call washed out positioning. And then beyond the near term, our year-end S&P price target remains 6,500, where we believe that prices can continue to rise alongside higher earnings. But we do think that the pace of returns will be more moderate than we've experienced during the last 2 years and with a lower risk-adjusted return like we've seen in the first 2 months of this year.
Thanks, Ryan. There's a number of positioning data which we all track. Probably our most comprehensive medium-term data set around this is the work that you publish on hedge fund positioning and mutual fund positioning. I think you analyze the quarterly filings of asset managers that total way over $7 trillion. You published both of those last week. Could you just run us through key takeaways from those quarterly reports?
Yeah, so we put out those reports looking at positioning as of the start of 1Q 2025, so before the sell-off. And yeah, heading into the sell-off, both hedge fund and mutual fund positioning and performance had been pretty solid. So hedge funds had been benefiting from their most popular long positions. Mutual funds had been benefiting from their underweight exposure to the Magnificent Seven. And both groups of investors had sharply increased their exposure to U.S. equities ahead of the recent sell-off. So this recent sell-off has been more of a challenge for hedge funds than mutual funds. As I mentioned, mutual funds remain underweight the Magnificent Seven, which have struggled year to date. And on the positioning side, hedge fund gross exposure was at a record high coming into the sell-off, and net exposures ranked in the 75th percentile relative to history. And so we have started to see those net exposures come down during the sell-off. But on the mutual fund side, cash balances fell to a new record low of 1.3% of equity assets in January. So both hedge funds and mutual funds were pretty long equities coming into the sell-off. In terms of positioning, there were two themes I wanted to focus on. First, financials, and second, the Magnificent Seven. So on the financial side, both mutual funds and hedge funds had increased their exposure to financials to record highs ahead of Election Day. The sector is viewed as one of the most popular Trump trades and has done very well post-Election Day prior to this sell-off. But during the quarter, we saw different approaches to the sector between the two investor groups. So hedge funds trimmed their exposure to financials in 4Q after Election Day, although that tilt is still relatively high versus history, while mutual funds really doubled down on their exposure to financials. So for the average large cap mutual fund, financials is the largest sector overweight, and they increased that overweight by 36 basis points in the fourth quarter. That was the most of any sector. And it was pretty broad-based, adding exposure to banks, capital markets, and insurance companies, whereas hedge funds got a bit more selective at the stock level with two financial stocks entering our hedge fund VIP list. Second, on the Mag 7, mutual funds continue to carry large underweights in the Magnificent Seven, in large part because of diversification requirements. We've talked a lot about this. Obviously, concentration of the equity market has increased because of the Magnificent Seven, and many mutual funds simply can't hold benchmark weights in these stocks and still be classified as a diversified mutual fund. And so that creates sort of structural underweights in these names. So if you look at, as of the fourth quarter data that we have, the average large cap mutual fund is underweight all 7 of the Magnificent Seven stocks, and in total is underweight the group by about 800 basis points. And so that was a big headwind to mutual fund performance in 2023 and 2024, as the Magnificent Seven did extremely well. But that's been a big tailwind to performance for mutual funds year to date, as the Magnificent Seven have struggled. So a large share of mutual funds outperforming their benchmark thus far. From a shares perspective, funds did trim their exposure to 6 of the 7 names in the group. Tesla was the only exception, and it was actually the most added to stock among mutual funds. Whereas if you look at hedge funds, the Magnificent Seven remain extremely popular among the hedge fund community. So all of the Magnificent Seven, except for Tesla, rank as the most popular stocks in our hedge fund VIP basket. But similar to mutual funds, hedge funds did trim their exposure to those companies during the quarter. So these are obviously super popular among investors and really important to the path of the equity market, given the record level of concentration. And as I mentioned at the start of my comments, the Magnificent Seven is down 8% year to date, while the S&P 493 is up 4%. And so that's consistent with a broadening of the U.S. equity market and also a broadening of equity performance across the world as well.
Some fascinating stats. Thank you very much, Ryan. I appreciate all your comments. With that, I'm going to hand over to Leah from Investment Banking for 3 more speakers.
Thanks, Mark. Just a reminder that I'm on the private side of the firm. I won't be sharing any MMPI, and I'm not soliciting or recommending that any investors take any action. Also note that the views expressed by my guests are theirs and not the views of Investment Banking. And with that, I'd like to welcome Christian Mueller-Glissman onto the call. He's our head of asset allocation research. Christian, couple questions for you. First, equity performance has broadened beyond the US year to date, with non-US markets such as Europe and China really starting to outperform. So European indices in particular, if we look at this, the pickup in performance and positioning follows a very bearish starting point after really a long period of weaker macro data where European equity fund flows lagged materially, especially versus the US. So really my question is on the back of this performance, how are you allocating assets in terms of risk and diversification?
Yeah, thanks a lot, Leah. I think you're absolutely right. It's been a big shift from the last 2 years, really, where the US have led performance. Performance in portfolios has really been concentrated onto US equities. I think they've materially outperformed versus bonds, and they materially outperformed relative to other markets. And we've been saying that this is really the result of, we called it an inverse Goldilocks scenario that the US delivered, where you were somewhat late cycle. So unemployment rates were and are low, profit margins are high, output gaps are positive. But you actually had inflation falling. Like normally what you kind of learn in the textbook is that when you're late cycle, you're facing inflation pressures up. But what you really saw is that you had a lot of disinflation still coming through from the kind of COVID crisis recovery normalization. And that created a Goldilocks backdrop, which was further boosted by AI. And it really created this US exceptionalism. And I think it really accelerated into year-end with the US election outcome, where besides the positive US exceptionalism, which we already had for a long time, you had then on top of that, this negative US exceptionalism come into focus, like tariffs and geopolitical risks coming from the US policy backdrop. And as a result of that, people got really, really bearish Europe and possibly China. And that created a very low hurdle rate to surprise to the upside, as you said. And you had a strong rally in both markets. In Europe, it was certainly triggered by Russia-Ukraine deal potential and the German elections. In China, the AI developments around DeepSeek played a core role. But I think the core point is that you had this very bearish sentiment starting point. And I think you still have a very bearish business cycle starting point. And so from that perspective, what we've been saying since the end of last year is diversification across markets will become much more important and create much more opportunities. And I think we have the early evidence here, which is mainly driven by sentiment, but we actually haven't really seen fundamentals follow. So you haven't seen positive earnings revisions in Europe. You haven't really seen as much evidence that the diversification fundamentally can kind of extend. And I think broadly, we do think there will be more opportunities to diversify. So we would certainly allocate across the markets, pick specific areas that have maybe lagged. So like domestic exposures, both in China and Europe, have certainly not followed in the recent strong rally. We do think that there's more opportunity in quality in Europe, in low volatility as a style. So we stick with the diversification theme despite the strong rally, but get a bit more selective within the markets.
Thanks, Christian. So, I mean, clients are growing increasingly concerned about equity correction risk, considering the current context and backdrop of shakier markets. So, we are also seeing a decent move in bond markets, which you've highlighted as more important buffer for portfolios in 2025. What are your thoughts on diversification as a trend going forward, and how does it play out within and across asset classes?
Yeah, listen, I think you said it already. What we've been saying coming into the year is that there is more benefit from diversification both within assets, as we discussed, and across assets. I think the bond market didn't contribute that much performance to multi-asset portfolios in the last year or two. And I think we think that will change because, first of all, the returns you can expect from risky assets are likely to slow. Because you have a different valuation starting point, you have a different macro regime, as I mentioned, but also because you kind of have like more buffer from bonds when you have a risk, when you have a shock, and we do expect equity bond correlations to be more negative, and we've seen evidence of that on a high frequency basis already. When you had DeepSeek, the announcement, when you had the tariff announcements, in a lot of cases, the bond market buffered. And as you said, you've seen a pretty significant decline in yields from close to 5%, closer to 4.3 right now. And I think the challenge you have is that from here, the buffer from bonds is starting to be a bit smaller unless something really seriously bad happens. And that's not our view. Our macro baseline is reasonably friendly. So we're more in the camp that you might see a correction than a bear market. But certainly the risk of a correction has picked up a bit. If you do look at our equity drawdown risk framework, which combines macro, market, and risk metrics, we're trying to estimate what's the likelihood of a 10% correction in the next 3 months, or like a bear market over the next 12 months. The likelihood of that happening has picked up. It's currently around 30%. The unconditional probability, so the probability of this happening at any point in time, is around 15. So you can see we've picked up quite a bit. And we're not in the danger zone yet. We always say the danger zone is around 35. But I think that the move in valuations into year end, the less negative inflation momentum I mentioned, the higher policy uncertainty, all of that has pushed the equity drawdown probability up. So the bond market has rallied a bit now. So you have a bit less buffer. So you need to think about other diversifiers. So we've been very much in favor of gold, which has been remarkably strong because of central bank demand, and we do see value there. You want to think about safe haven FX, like the dollar and the Swiss franc. The dollar had a bit of a setback in function of the recent non-US optimism. So I think there's plenty of opportunity to diversify a bit more in alternative safe havens to bonds. And then you should be able to create balance in the portfolio to deal with a lot of the shocks. On top of that, you can think about selective overlay hedges and alternatives. I feel like in a lot of our client conversations, which is typical late cycle, when valuations are richer, you see more focus on incorporating alternatives and incorporating hedges in the portfolio. So I think that's another thing that probably for 2025 remains a core area of focus.
Thanks, Christian. We now have Nicholas Gardnett on, our German economist. Nicholas, a few questions for you. The CDU-CSU won the election last weekend, and the CDU-CSU-SPD coalition under Friedrich Merz as chancellor appears very likely. But the far-right AfD and the left-wing Linke gained 216 seats, which is about 34% of parliament, and they could form a blocking minority against fiscal reforms, which really is going to complicate the fiscal outlook for the country. So I'd like to get your view on what's the timeline from here on the formation of a new government, and how do you think this unfolds?
Yeah, so I think for the negotiations, it's quite positive that only two parties are negotiating, so that a two-party coalition is possible. And that was actually a knife-edge decision, as the BSW, also a smaller party, missed the cut of 5% by only 3 basis points. It's 13,000 votes. And them entering would have made a two-party coalition in the center impossible and would have complicated negotiations a lot. Now, preliminary negotiations between CDU, CSU, and SPD have started on Friday, and that's quite a positive surprise, about a week earlier than we have originally thought. So that could spark some hope for fast coalition negotiations. Now, these preliminary negotiations, they first decide on procedural matters, i.e. which working groups come together, what's the rough timeline, what are the main points of disagreement, where compromise has to be found. And then the main negotiations are then likely to start in a week or so. And by that time, we should also get a rough timeline then how those main negotiations should unfold. Now, Friedrich Merz has always mentioned that he wants to have a government by Easter. And given the earlier start of negotiations, that's, I would say, a good sign that party leaders of both parties feel a sense of urgency and want to conclude negotiations quite fast, so that Europe's largest economy has a functioning government with a parliamentary backing again. Now, that said, I think in particular the fiscal questions, given that we now have this blocking minority, are much more complicated to decide on, and we could see some surprises in the next weeks there.
Thanks, Nicholas. So what does this mean for options available for delivering on spending, and in particular on a focus on defense in light of US pressure?
Yeah, so as I said, the potential blocking minority by the Linke and the AfD makes fiscal reform quite complicated, in particular increasing defense spending. So just to recap the position of those two parties, the AfD oppose any increase in deficits. They're basically in fundamental opposition there. And the Linke, while supporting increases for, let's say, infrastructure or social spending, they fiercely oppose increasing defense spending. So that makes it quite unlikely that that a defense fund, which would be one vehicle that we flagged in the past to increase defense spending, will be passed in the new parliament. So that would be an off-budget fund that bypasses the German fiscal rules, so to say. Now, those fiscal rules, the debt brake, they could be reformed, and they could be reformed actually with support by the Die Linke, by the left party, given that they are in favor of reforming it according to that program. So there, a solution has to be found that assures them that additional funds won't be used directly for defense. And one way that could work is if within the debt brake, the deficit limit of the lenders, so the regional level, is increased. They don't spend on defense. Defense is a federal task, and then basically the Linke could say, okay, we just increase the limit for non-defense spending, and then the new government would somehow have to get creative in reshuffling funds, reshuffling spending to free up space for defense at the federal level. So that's one way to go. There are, however, some ways to get around negotiating with the AfD and the Linke altogether. And one quite creative solution that has been floated by the Green Party on Sunday evening, so on election night, is that the old Bundestag, so the old parliament, retains its constitutional powers until the newly elected parliament convenes for the first time, and that is scheduled until for March 25th. So basically for the next 3.5 weeks, the old Bundestag still retains its powers. And in the old Bundestag, the AfD and the Linke have no blocking minority. So in principle, an off-budget defense fund, or a reform with the debt brake, or an off-budget infrastructure fund, which is something that the Greens and the SPD would like to have, could be passed there without having to resort to votes by the Linke and AfD. But the time is short, and this would be also highly controversial, as this would be the first time a law or even a constitutional amendment is passed in this way. So after an election and before the newly elected Bundestag convenes for the first time. So I think it's quite controversial, and I'm not sure whether they will really try to pull that off. And then after March 25th, so after the newly elected Bundestag has convened for the first time, there are also additional options like triggering the escape clause of the debt brake, using EU funding, or using creative accounting under the debt brake rules. So overall, because there are so many options to increase fiscal space, we think that some way to increase fiscal space will be taken, and fiscal policy will be somewhat loosened. We think, however, that this will mainly start to kick in 2026 and 2027. So we updated our deficit projections and growth projections for Germany at the beginning of the week. And we think the deficit will be increasing by 0.1 percentage point above our previous baseline in 2025, by 0.2 percentage points in 2026, and by 0.4 in 2027. And this increase in the deficit, this fiscal impasse, will then also translate into a modest upgrade of our growth projections, which increase marginally in 2025 and by 0.2 percentage points each in 26 and 27. So we see a modest boost, growth boost in the medium term.
Thanks, Niklas. We now have Karsten Warren, our co-head of M&A in EMEA and investment banking. Karsten, at the end of 2024, the market was expecting a strong recovery in M&A volumes in 25, given the pent-up demand of 3 years of being below trend in M&A, lower rates, unlevered balance sheets, and $3 trillion in sponsored dry powder. So we've seen this start to manifest with the pickup in corporate action in Europe. What do you take from this rise of activity, and where do you see that trend going forward?
Yeah, so thanks. So taking a step back and looking at M&A broadly, we are actually encouraged by dialogue levels that we are seeing this early in the year with both corporates and financial sponsors alike. And so while average weekly global M&A volumes around $50 to $55 billion are still lower than the $65-ish billion average volumes over the last 3 years, we do feel a pickup in large corporate and sponsor deals coming to market. So look at, for example, the deals recently announced, Monty Dye Pasqui's $14 billion takeover bid for Mediobanca here in Europe, or Constellation Energy's $29 billion acquisition of Calpine in the US. So both of them are real precursors to more larger deals to come.
We have currently good visibility into an active pipeline of transactions now that we're finally facing greater clarity on the macroeconomic level and quite frankly, regulatory headwinds that seem to ease a little more on both sides of the Atlantic. Our clients are discussing the art of the possible now with us in a way they were not pre-election, whether that is in the US, the UK, or across Europe. Again, I think still too early to know definitively, but we have more certainty than we did a month ago. And I think we also have we will have more certainty in a month from now again. What we do now, however, today, sitting here today, is that the underlying drivers remain strong. Rate cuts, even though in the US you might think interest rates are here to stay for longer. In Europe, they're coming down. Continued pursuit of strategic growth, continued demand for strategic repositioning, as well as sponsor dry powder, of course. So we expect M&A volumes to normalize towards 10-year averages in 2025, seeing continued pent-up demand as M&A volumes as a percentage of global market capitalization stands at only 3.1%. That is actually the lowest in 30 years. So by the way, we expect to see that not just in the US, global deal activity continues to improve also with the globalization of corporate simplifications and the broadening of activity across industries. So earlier in the year, you will have all seen that Honeywell announced the separation of its aerospace and automation business in the form of a roughly $100 billion spin-off. So more to come on that front. Europe in particular is active amid pent-up demand following an extended period of muted activity. But we're also encouraged by what we're seeing elsewhere in Japan and in India, as well as broader cross-regional activity, which has remained muted over the past few years. The sponsor activity in particular continues to gain momentum as well, especially in sponsor-to-sponsor deals, with 2024 global volumes up 12% year over year. Sponsor activity surged particularly in the third and fourth quarters last year, with sponsor buyout volumes now soaring about 42% over 2023. And then on top of that, if the long-anticipated wave of portfolio company exits from sponsor inventory finally starts, that has the potential to really bring sponsor M&A as percentage of total M&A back to closer to 40% contribution from a low of 30% last year. That will be the normalized level, so the 40% level, and that is what we're expecting to come through later this year. Last year, sponsors have been incredibly active in take privates of public companies, as we have seen in the market, at an all-time high volume. And if sponsors start the long-awaited wave of portfolio exits, we will see sponsor M&A volume returning to those normalized levels. So, give or take the 40% contribution to total M&A. And then, of course, finally, continued investments in AI infrastructure, platforms, and applications has the means to further accelerate M&A activity this year as well. So all in all, we are relatively optimistic that 2025 will be a solid year for M&A at the global level.
Thanks, Carsten. So while scrutiny for competition authorities remains elevated, both the CMA and the EU DG Comp have seen recent leadership changes with a refreshed, more open approach to reviewing transactions. The same is expected to be the case in the US. So what do you think is the immediate and longer-term impacts we are seeing, and can we expect to see the M&A landscape going forward be different? And just in addition to that, how do you anticipate these trends impacting cross-border transactions and deal structures?
Yeah, so over the last few years, we have faced significant regulatory headwinds on both sides of the Atlantic. The higher scrutiny of large-scale combinations across geographies and sectors, and of course, Nippon Steel, US Steel being one of the latest, most prominent examples that we have seen blocked by the administration in the US. So over the course of the last year, however, we've also seen change both in the US as well as in Europe and also in the UK. Now, in the US, for example, with the new Trump administration, we do expect a more pro-business stance to business combinations, with possibly a less aggressive approach to enforcement overall, possibly a return to accepting more traditional merger remedies, less delays, and fewer challenges overall, akin to what we have seen during the first Trump administration. In Europe, we have a new commissioner for competition, Teresa Ribeiro Rodriguez, whose mission is to modernize the EU's competition policy to ensure it supports European companies to innovate, compete, and lead worldwide, as self-declared by the EU Commissioner, and to develop a policy that contributes to the EU's wider objectives on competitiveness and therefore possibly being more supportive of companies scaling up in global markets. And on that last point, and on the back of the Draghi report and in the wake of the new global political landscape, more discussion, of course, about the importance and creation of European champions is certainly front and center of clients' minds, as you can see already in some of the recent consolidation moves that we have seen across the pan-European landscape. Now, finally, in the UK, we've also seen recent leadership changes at the CMA, so the Competitive Market Authority, introducing procedural changes for a more transparent, collaborative, less adversarial approach and more constructive engagement with the CMA, and possibly also a more flexible approach to deal approvals. So I think all in all, we see changes and anticipate a general easing of the regulatory headwinds that we have been facing in the past years. Now, when you look at the numbers from last year again, we have clearly seen this translating into lower large-scale corporate M&A activity. Most corporate M&A activity in 2024 was primarily concentrated on small and medium-sized deals, which face less regulatory scrutiny. Since the US elections are behind us last year, we have witnessed a clear pickup in dialogue with our clients with a much more significant focus on large and transformational M&A deals. And like I said earlier, with 3.1% only M&A volumes as a percent of total global market capitalization in 2024, that was at its 30-year low. That was in very large part driven by the very low number of large and mega corporate M&A deals. And by the way, we define large deals as deals with an enterprise valuation of more than $10 billion and mega deals with a valuation of more than $20 billion. So to put things in context around this, large deals were globally down 40% compared to the longer-term averages pre-COVID, 29% down in the US, and even more so in EMEA. When looking at mega deals, that volume was down 40% globally, not relative to the long-term average, but year over year, so from 2023, and there were none, i.e. zero deals of that size in EMEA last year. So going forward with regulatory headwinds easing and possibly turning even into soft tailwinds, we expect a reacceleration of large corporate deal making as corporates continue to pursue their growth strategies, whether that's by product, technology, or geography across the globe.
Great, Carsten. Thank you very much for your comments. Leah, thank you. Thank you to all of our speakers this weekend. Thank you all for dialing in and listening. I'm sure there's going to be plenty to discuss again next week following another eventful week out of DC. Good luck in markets this coming week. We'll be back, of course, next weekend. Good luck and have a good week.